All right, peeps, welcome back to 10x Club. This one is for everyone, so not only paid subscribers but also free subscribers. Given the panic in the market, I think it's wise that we just go look over what's going on right now. So the main topics of this last week were, well, Silvergate, bankrupt. We already knew that. Not such a huge deal, more for institutional players than for retail. Honestly, market reacted quite okay on that. The big news of this week is mostly Silicon Valley Bank. All right. So I found a guy that used to work there, had a lot of emails, la di da di da. So KPIs, key performance index. So let's see what he says. 3% was their target. Let's see. Increase, high rate, blah, blah, blah. So they are talking here about that they had to, very short story is that they had to drop a lot of their excessive cash flows, or that they had a lot of cash. Obviously, banks have a lot of cash, and they drop it into securities, so in bonds, right? So when they do that on a time where interest rates are very low, right? So we've come out of a time where interest rates were very low. What happens then is that if the interest rates then shoot up, these old securities, these old bonds, they drop in price, right? Because what do you have? You have the option to buy an old bond for, let's say, 0.5 or 1% yield, 1.79. Now it's 5%, right? So the old bonds are worth much less than the current bonds, right? So the bond market really dropped. That's not a real issue if you have, you still make money on those, right? So 1.7% or 1%, it's okay. You still get your money for those. But if a lot of people withdraw their cash from your bank, you need, in order to create cash flow, you need to sell those bonds, which means you need to sell them at a huge loss, right? And then basically you get only, let's say you invested 1 billion into these bonds, let's say you get only back $500 million or even worse, right? So you really have huge drawdowns on these investments. Now the other thing is with this bank is that they were very active in the most risky place where you can be, which is venture capital, right? So, a lot of VCs tell their companies to move funds. So this is what the bank run was fueled by, right? So you have a lot, this bank is really, let's say, the bank for startups and VCs, right? So the big startups and the big VCs. So when VCs, they are obviously, constantly checking out the market, see what's going on. And then they see, oh, there's a risk at Silicon Valley Bank. Let me call the startup that I invested in and then tell them to get out. And so this created a cascade effect, a bank run basically, which forced Silicon Valley Bank to start selling those underwater securities, right? Now, honestly speaking, if you get a bank run with any bank will be in trouble. The point here is those like, okay, where does this situation sits in the grand scheme of things for crypto, for the overall market? Is it something like, I hear people saying it's something like the 2008 banking crisis? I try to give answers to this on this in this update. So we have this Silicon Valley Bank. Let's see which crypto companies first are in this problem. So we have BlockFi. I don't care about BlockFi, whatever. Circle, which we do care about. We've seen USDC, Deepak. I actually said yesterday on Twitter when I saw Circle had exposure, I said, get out of stables, right? And let's say the short, if you don't want to watch this whole video, the short conclusion of what I think is sensible, what I am doing. I'm not giving you any advice. I'm just saying what I am doing and the way I view the situation is that stable coins are replaceable, right? I mean, USDC is relatively new. Then you got like UST, which was new as well. BUSD, also relatively new, all like less than 2 or 3 years old, right? And they come and go. Like they go from 0 market cap to 30 billion market cap. It's technically not that difficult to create a stable coin, right? You just need money and it needs to be secure, and the only function is to be packed at $1. So stable coins can come and go, right? But projects like, let's say, Ethereum or Bitcoin or other projects with great use cases or great technology, they are not easily replaceable. You're not going to just replace Apple like in a few months. It's not possible, right? So where like what can you do? Like maybe some people say like Bitcoin goes back to 3K, blah blah blah. There's going to be a liquidity crunch because USDC is now in trouble. Maybe we have Avalanche in trouble. Well, Avalanche we're not exposed to because that's also the reason. Kind of like I filter on these things. Yeah, you missed out on people that didn't sign up. You guys missed out on on me telling you my portfolio. But we have zero exposure to Avalanche. So let's see what's the deal here. So to make my point, what I think is more safe at this time, and I actually said it already before this whole stablecoin crisis took off. I think, and that's just my opinion. You could totally disagree with it, and you should totally do your own thing. But I think it's safer to be in projects that have a long-term fundamental value in this space. Now, I just gave you last week an update. I gave you a full list of projects that I think they could do well over the long period of time. So they are not easily replaceable, right? So stable coins, let's say a few more banks, they collapse, related to crypto, right? So related to either tech or crypto, they can be replaced, anyone can bank really. And also one thing I think what should happen is what I see potentially happening is, and this is very this would be very funny, I could see Apple starting a bank because Apple sits on huge amounts of cash, and I honestly don't see why would they not take custody over their own money by starting their own bank. They also have Apple Pay. They have tons of mobile phone users. They should start their own bank. But to come back to my point, because I'm drifting off, I think it's safer to be in fundamental long-term projects, not in bullshit coins, but in good coins, in good projects. And to sit out, I cannot guarantee that the market's not gonna go lower. Where we bought was around the November, December lows. Now some projects already, I would say now half of our portfolio is underwater, other half is still okay. We have the most weight in projects that are still above our entry price. But in this kind of situations, what you could still do, right? You could say, well, I don't want to be in a drawdown, so I'm going to go to stable. Then I would say, which stable? BUSD, illegal, right? USDT, very shady. What else is left there? Pax Gold, you want to go into gold. Pax has also problems with regulators. I don't see, I don't see what's safe of putting your trust in USDT, which are very shady, you know. So I honestly don't see any way out, and also don't. Where are the safe off ramps? Like you could say, you know, I have my crypto in my wallet, I send it to exchange, I sell it for, I don't know, USDT or USD, like, you know, stable, not stable coins, but actual USD or euro. And then you request a withdrawal. And then, I mean, if you look at Coinbase, massive losses. Binance, Binance, the only one that is still in a strong position. Kraken also pretty okay. But look, I don't want to vouch for any crypto exchange right now. I don't want to vouch for, you know, if you do a withdrawal right now to your bank account, it's still to be seen if it even arrives. So the only point of like sort of security that there is right now is to have self custody over your coins, and hopefully you got them at a decent price. And even if your portfolio will still go down, you just have to sit it out. Really, like there's honestly, I mean, you don't have to. You can do whatever you want, but that's what I'm doing. I'm just sitting it out. I will see the storm when the storm settles where we stand, you know, because I'm also like, this portfolio is for me a 5 to 10 year plan. So if you invest something with a horizon of, let's say, 5 to 10 years, you're not gonna look, what are we now? It's now March. So you're gonna look after 4 months if you made any money, and if you're in a drawdown, you're gonna say, well, this was a bad idea, I'm gonna pull out. That's, you know, makes no logical sense. So that's just what I wanted to say. So BlockFi, I don't care about them. BlockFi is shit anyway. Circle, well, we got that. Pantera, it's I think it's a VC. Yep. So we got some VC trouble here. Avalanche, Yuga Lab. So what they got? Avalanche 1.6 million. That's not that much. Yuga Labs, Board 8 Yacht Club, bullshit. All right, Proof, NFTs. Well, let the NFTs please drop to 0, because most NFTs, I'm not a fan of NFTs. Like not about NFTs without use case, but that's just my opinion. No exposure. Tether, no exposure. Yeah, they cannot bank in the US. Solana, no exposure. Polygon, also no exposure. Okay, so now I dived into the Fed stress test. This is the Fed stress test from 2022, and that's the most recent data that we got to see whether the banks are healthy or not. Now, banks they have fat on the bones. And why they have fat on the bones? Because, you know, Fed has been pumping a crazy amount of money into the market post Corona lockdowns, right? Fact. So where do we see most of the problems arriving? Securities losses was negligible, like what they said in with the Fed, and they see most problems arriving in commercial industrial loans. So here, like that's likely. That's a bit speculation because I don't know. I cannot look into the books of SVB, but that's likely that they had very risky loans to either VCs, to startups, etc. Right? So the highest risk category is VCs, really, and I honestly wouldn't mind if like a bunch of VCs go wrecked, because VCs are the most wasteful form of capital I've seen ever, really, because what they do is invest money into startups that are run by people that they think are capable, which is just meaning like either you come from a fancy university or you've worked for some fancy startup in the past, basically. And they mostly come up with like funding, like, you know, we had so many examples of like this juice maker, and there was this like weird what's this lady called again that was with Jim Cramer on this show that said like she was the new Steve Jobs. You know, this kind of bullshit startups and low use case companies. And oh my god, like there's definitely a lot of good startups out there, but honestly most of it is junk. And there needs to be what I already know, because I am, you know, I'm involved in the same sector, is that most VCs are running out of money because they FOMO'd into a lot of bullshit in 2021. They have bad cash flows. So what I hope to see from this is that Europe can be a new playground, let's say, you know, industry market that regulates crypto and allows for real innovation in the crypto space, but also in tech. And I hope that VCs will learn to look beyond, you know, the hype, because that's literally what they're doing. Like, if you, that's also how we invest. Like like most of our coins are not really hyped, you know, but we know in the future that they will do really well. I'll give you one example of one coin, and then, you know, free subscribers can grab one coin from our list. So Binance, what is Binance exposure to USDC? They have $3.5 billion worth of USDC, which is 5,500% overweight to what actual customers have on balance, which is 65 million. So this is really, this is a huge difference, right? It doesn't make sense that Binance holds 3.5 billion USDC, while they only use or only need to hold 65 million, right? More or less. So this DPEG, to me, it sounds like Binance is dumping like USDC like really hard. They also just introduced a new stablecoin, TUSD, which True USD, if I say that correctly. I didn't really look into it properly, but yeah. So I mean, they need to get rid of their BUSD here, which they can with Paxos. They can just get rid of that one-to-one, and they need to also get rid of USDC. So likely they're gonna have a lot more USDT, and they are introducing a new stablecoin as well. I honestly don't see that much trouble for Binance. It's manageable for them. And so why is that manageable? We go into that a bit later. Now I want to look at like, okay, what are the problems? So we have these banks. Okay, Silicon Valley Bank. Okay, now this guy, I like this guy, Wasteland Capital. I want to really focus on the big tech companies, because especially Apple, because they have the biggest weight in S&P and the biggest weight in the Nasdaq, right? So if Apple goes down, Nasdaq goes down, S&P goes down. If Apple goes up, same. So we have Apple, earning wise, they were a bit below estimates, but they're still doing relatively well. And that's really like, also their stock does relatively well. And, you know, they're 60% higher than COVID-19 levels. So the Corona crash, let's say, was 2019, 2019 earnings. So that was pre-Corona actually. So I think that's not bad. It's not their product revenue is still quite good. Their cash flow is good. Like they still have positive results. So I'm not yet too worried about Apple. And the good thing about Apple is they sell phones, and everybody is like addicted to their phone. So like they're in a business that survives based on like people's addictions. Also, just looking at the Apple chart, we're still above the bull market support band. Not huge selling pressure here. We do see, it's not huge volume, but it's, the drawdown was not significant, but still there, so 4% over 2 days. We kind of have to see what Apple's gonna do, around these levels here, 140. Maybe it holds the bull market support band, would be a very nice thing. We need to keep monitoring on that, because we do have this gap here that I don't like, and that could be a dangerous thing. So let's just keep going. So yeah, why do we talk about Apple? Because they have so much weight, right? So I just checked here. This is the latest thing I could find about the stock market and tech stocks, or the top stocks basically. Is, as you can see, if you take the biggest stocks out, you can see the difference between what the stock market would look like, right? So basically that's why you see things like whatever, like let's say Netflix dropping, what was it, 60-70% last year, and S&P doesn't do anything, right? Because they don't have any weight, or that's the Nasdaq, but whatever, you get the point. Like the top stocks rule the stock market. So this is the same one again. Apple's still okay. Now the earnings estimate, they coming down, and we've talked about this as well. We expected earnings to come in lower, obviously, because we're in a recession. Factually, we still had some GDP growth, but we're effectively in a recession right now. It's not that hard to see. If you just look at the numbers, the only problem what we have right now is there's still too many job openings, and these are very lagging indicators. We see a lot of companies doing layoffs. So let's talk about the Fed, right? So everybody right now is like, oh, job openings are still higher. Why is this relevant? Because more people have a job, the more demand there is for products. The higher are the prices, therefore the higher is inflation, right? So the Fed wants to slow down the job market and the housing market, and to crush demand, right? To crush liquidity. If you crush liquidity, you can do that with the housing market as well. Now, housing market comes down, inflation has come down as well. What we need for inflation, like at bare minimum, inflation needs to come down below the current federal funds rate, right? So inflation right now is what is the CPI right now? 5.4, something like that. It needs to come down below the current federal funds rate, which is 4%, if I'm not wrong. And so that's the main thing. I don't think the Fed needs to do crazy things. The thing is that all of the Fed's actions, they have lag, yeah, and so you will just have to wait. Like the Fed already did enough to bring inflation down. I'm not one of those doom thinkers that thinks inflation will not come down. I'm much more concerned about European inflation. And so effectively what we will likely see is inflation coming down over this year still. But it lags, we have to kind of be patient for it. And what we will likely see as well is that the euro will do much better than the dollar this year. And that means what? Like, why? Because the euro, the ECB will hike much faster this year than the Fed, because they are behind, right? So the euro is already 50 basis points. I think the Fed will do 25 basis points, and at some point they will pause rate hikes this year. So that's just my prediction there. So what I will think we'll see is like a ranging stock market for over this year. But you know, if there's higher contagion because of these banks and stuff, and earnings really drop significantly, we can see also a massive drop in the stock market. But the point is though, like as you can see, this drawdown is not huge like on stock market. The thing is though, why is that? Because Apple and those companies, they still doing relatively well. Amazon is doing not that well. Google is doing okay. So we kind of have to manage, and we kind of have to just see what's going to happen there. So last time in my update, we talked about, you know, this was literally from a week ago. We talked about this gap, right? We're now right into the gap, right? We filled the gap. We're hanging here on the bull market support band for Bitcoin, and that's, you know, that's really a great level. It's also volume weighted coming out of this sideways action from here, right? So if we look at Google, you know, the forecasts are always a bit too high, but you know, they're doing relatively well. You know, forecast way too high than we had. But you know, that's the, you know, this is the problem, you know, where if you have high forecasts, you will see that they're below, you know. But if you have a bit more, let's say if you have a bit more realistic forecast, then it's also more realistic for companies to actually manage those. So this is the situation in crypto right now, and I just asked on Twitter, do we need a deleveraging event? I think so. And deleveraging at this moment, normally you say deleveraging is to the downside. This currently it's to the upside. Like this is was yesterday the open interest. Oh wait, this is the open interest profile from 10th of November. This was post FTX crash, and if you look at it today, sorry, this was post FTX crash. If you look at it today, it's very similar. Like this is almost the same video I made like back in November, talking about, you know, high volume. Look how many longs we've been taking out here. So we went to 19 and a half, exactly where this yellow stops, and now we have huge open interest to the upside. This is the one from this is the current liquidation map. So as you can see, most of the volume is here. So you know what we need is the so the FDIC is going to step in for Silicon Valley Bank, and what they effectively need to do is calm everyone down. Okay, so we need FDIC to calm people down. Say like they're already like looking at how they can step in to save customer deposits. They can actually, I mean, if they're smart, they can actually play around with the current interest rate and kind of like pay out people over time, because you have high interest rates. So you can actually, you know, can do some tricks there, but I don't know how creative these people are. But as you can see, we took out everything till here, basically. 19K is here, right? So we took out everything here. And now we basically, what we had before was liquidity till 24K. I said this literally in November. Now we have liquidity. You cannot see in this chart. We have liquidity till 30K. And this is our magic number for this year. I still think we can hit 30K this year. The point is though, we need to just manage our expectations. Like we cannot be like, you know, invested in our portfolio and think, oh, boom, we're gonna, you know, get rich in a few months' time. Now is not the time to look for gains. If there's any time to look at right now, it's time to buy, in my opinion. In case you didn't spend all your money yet, I'm actually fully invested right now, and I'm just gonna keep my coins safe, and I will sit on them even if they drop another 50% or 60 or 70 or 90. I don't care. Honestly, I don't care, because there's nothing for me to do. Like if I send stuff to an exchange, I'm only gonna get myself into more risk, because then I can drop minus 100% if this exchange potentially runs into issues, right? So we had also, that's also again a thing, we had KuCoin, a New York Attorney General sues KuCoin. Well, which crypto exchange did the New York Attorney General not sue? We talked about this, in my latest newsletter already. That they're all fighting for who gets to regulate crypto, right? The crypto crackdown. We talked about this, and it's such a show. It's such a show because they want, like, Gary wants to be boss of crypto, and then you have the CFTC that wants to be boss of crypto. So it's such a show, right? Next meeting here, the CFTC is talking about DeFi. It's such a, it's very contrasting, because actually these are all good developments, because if they didn't want to regulate crypto, right, then it means that they don't care about crypto and they will just let it bleed to zero. No, they want to regulate crypto because we're gonna get a CBDC. And let me go to the CBDC piece here. First and foremost, so CBDC, move over stablecoin, new token is coming. So this article about in the Washington Post, that CBDCs are coming, and CBDCs will come in two forms. They will come in a institutional CBDC and a retail CBDC. So a wholesale, they call that wholesale CBDCs for banks and institutions, and there will be a retail CBDC. Now, whether you against CBDCs or in favor of them, I think they definitely need to be implemented with the necessary privacy, and they cannot be like some sort of controlling devices. Likely they will be like that. I'm definitely not a fan of that. Yet we're positioned for that, because if this poison will come, let's say, if we need to drink this poison, then we better take advantage of it, right? And so what will these CBDCs run on? They will not run on Ethereum. They will use Ethereum technology through private blockchains like Hyperledger, right? And these blockchains need to connect to legacy systems of banks. Legacy systems are just the current systems they use. They're usually very old, from the 80s or the 90s. They cannot just interact with blockchain like that, right? So they need to be connected. And who does that stuff? Quant network. And Polkadot is also mentioned in here, which is it could be used as a interoperable solution between blockchains. But ODAP gateways is something. ODAP is a protocol that that Quant developed. Quant also worked with MIT. That they get mentioned here, and this is not a white paper from years ago. This is a very, very recent white paper, and I am super hyper bullish on Quant. Honestly, it's also my biggest exposure in my portfolio. This is very recent, and this is a white paper, a new release of Hyperledger, which is one of the biggest, together with R3 Corda, is one of the biggest private blockchains out there. Now, so again, long term, we don't have to worry about a portfolio, honestly. Now, we had Hedera exploit this week as well. Luckily, it happened in such a busy week, so no one really noticed that much. Hedera was exploited, smart contract relating to liquidity pools on SaucerSwap and Uniswap. Hedera team acted very fast. It was only 400k getting stolen. Very little for Hedera. Hedera also has a really good cash position. Honestly, they raised a lot of money. They backed by a lot of big companies. Okay, here's your second coin. We invested in HBAR. So look, Is Hedera more centralized? Absolutely, absolutely. But it's a very good technology. As you can see, we're running we're back up running. Hedera mainnet is back up running. Basically, they turned off the proxies. No one could do anything on Hedera for a few days. So also not the hackers, let's say. And so yeah, they fixed the problem and they're now back up, basically. And so this is sometimes having a bit of centralized power is not a bad thing, because they could immediately stop these bad actors in their tracks. They stole only $400,000, which is not much relative to other hacks that we've seen in crypto. We've seen similar problems with Ethereum or other big protocols. It's not, it doesn't mean that a protocol is dead just because it gets exploited. Like, think of like how many problems Microsoft or even Apple had in the past. Like, it's honestly a standard thing. I think the most important thing is how a protocol reacts to it and fixes the problem is more important than the problem itself. They did really well. They turned off all the proxies, made sure no one could steal anything anymore. They went to work, fixed the code, tested it, deployed it again, boom, and we got mainnet up and running again. So good job, Hedera. Okay. As you can see here as well, upgrades has. Okay, so they have a scheduled update is going to be cancelled, and they will be upgrading. Blah blah blah. Okay, so they have resolved. Mainnet has been upgraded to the patch vulnerability. Mainnet is now running. Okay, cool. So let's look at some charts. So I wanted to like pay a bit more attention to the people saying like macro. Okay, cool. Macro. Let's talk macro. Like you can value the stock market in absolute terms, which is just saying Nasdaq against the dollar, right? Now, if you do Nasdaq against the money supply, then you see this here. This is a huge gap, and this is how much we have been pumping money into this market. Now, that's also where our inflation problems came from. Like, people can come up with any fucking story, like, about the war and stuff. Like, I really am against this war. I'm against any fucking war, but like, inflation did not come from war, did not come from any fucking other reason than huge like trillions being pumped into the economy. That's just reality. Anything else is just politicians lying to you, honestly. So if we look at the relatively value of the Nasdaq against the current money that's available on the market, we're back in 96. Okay, so that places stuff into perspective, right? We've been talking about the 10-year yield. I think Powell's going to back down a little, and as you can see, it's been following my path greatly, where I think yields on the 10-year could be peaking out at 4.5%. I made this analysis on 12th of December. You can go check on my Twitter. It was posted there. Anyways, so 2-year yield is still spiking up, which is normal because we do expect I do expect the federal funds rate to hit maybe 5%. Federal fund effective federal funds rate. So we are now at 4.5. We are looking at 5, right? I mean, let's take CPI as well, if we can have that here. US CPI. Yeah, no, this is an annoying chart, right? It's an annoying chart. I don't like this. US CPI right now. So next week we have US CPI. What's my website called again? I forgot it. Forex. Here we go. So Forex Factor you can check for the economic calendar. Where are we? 11th of March. More. Okay, so we're gonna have a nice week here. We're gonna have a PPI on Wednesday and CPI on Tuesday. Now let's see what we have month over month. Let's see for year over year. So we're at 6.4 right now, right? And so we want this CPI to at least go below 5 this year. Now the real-time CPI is like 5.2 real-time CPI month over month. So, you know, I think, what's the estimate right now? Do we have an estimate? We have 6 as an estimate. I think that's reasonable. I think they will hit estimate. What we have estimate here? Estimate is 0.4. Could be lower than that. Like, well, let's see. It's oil has been ranging, not doing that much. Will be an interesting week. So what we can understand is that the move before the CPI will be the false move, right? So, you know, effectively, technically speaking, us dropping so low on many markets could indicate that the CPI will come out bullish, because if the CPI will come out bearish, they will pump the market. But we have to see what happens on Monday, right? So we got that. All right, so back to the market cycle, right? Like if I try to, it's a bit hard with Bitcoin, but if I try to do honestly track the market cycle, right? I think that, you know, let's say this belief was here, the Corona crash, and this is like hope, optimism, belief, thrill. Like I think this is a very sort of honest overlay of the market, right? I think you guys agree with me, right? I'm not trying to put it into my favor, let's say, right? So complacency was kind of the second peak, I would say, right? So if, you know, it doesn't overline one-to-one, right? But then, you know, denial, capitulation was definitely here, because we had all the companies capitulating in June. Then we had anger in this phase of like sideways and So the point is, the main question is this depression? Is this the low, right? Right? If I overlay this like this, you know, are we going to do depression here, or was that depression, right? So that's, you know, because it set its lowest low there, right? But so you could argue that we're still gonna go lower. You could argue that, but also if I would place this in line with the peak, right? Let's say I just align the peak. Yeah, then this is very much aligned, basically, right? So you could see this both ways. I mean, you could also say we're somewhat like this and trying to go into the disbelief place in any form of way, right? So if you look at just this chart and you would have bought here, then you would literally have a few days here that it goes below your entry point. So if we bought all here, like that's where we bought. Like we bought the mid-November, right? If we look at ARC is really beautiful because that really tracks really well. We're pretty much at the same place. So honestly speaking, in a long-term view, these areas are not a bad time to view to buy. Now, where can ARC go to this? Let us say take the most bearish scenario. Then ARC, which is one of the, let's say, high risk indexes, which is the Katie Woods Ponzi index, could go minus 38%. Yeah, so I would say that's worst case for Katie. Yeah, minus 38% is quite a lot, but it's relatively speaking where she came from, it's not that much anymore, right? Because she just had minus 77%, and from top to low, it's minus 81%. So in relative terms, I think the worst is already behind us. It's like, people say we're gonna have a crash to 3K. I don't see that. Like, if you want to do your market cycle thingy and be a bear, that's fine. And I listen to both sides, but I don't really see. I don't see what I mean. People say we still have to crash, dude. We already crashed minus 80% on these things, on all coins and all big high risk indexes. So who's still gonna sell? Like, people have been already selling everything in 2022. So that's basically my point. Also, looking just at technical analysis, I did this once again with like overlaying the top here on the total crypto cap. Top is here. You have a head and shoulders. Your target out of head and shoulders is the distance between the neckline to the head. So if I move this thing to here, which is exactly the same thing, and did not cheat, you can exactly get the bottom out of the target, right? And the funny thing is here is that if you track this like this, it very much tracks well in line with the total market cap having already bottoms. Now this is obviously, here we're testing the bull market support band. Let's zoom in a little bit. That's obviously very in line with the top is in line. We've seen that, right? Top is in line here, and the bottom is also in line on the weekly chart. So it aligns quite well. I think these things are better for indexes than for a single project, like just single Bitcoin, let's say, right? So it's a level to hold here, but we can go a bit lower. We have some demand zones here as well. Basically this zone here. If you say this is a very beautiful W, so basically what you normally, let's say technically do is set a W and retest the neckline of a W, which is exactly here, let's say around 835, which is relatively, it's like another 10% basically from where we are right now. And then you get this could be your first wave up, right? The point is though, it's like where do we see the biggest imbalance on the chart would be below here, right? If we could take the bearish case, this is an imbalance, but it is filled by previous price action here, right? So the biggest imbalance would be, in my opinion, basically this zone here, actually maybe even up till there, right? But we have to temper our expectations a bit, so we have to just see, honestly. Do we have anything else that I want to show? Let's see, do I have anything else? So yeah, so okay, this is the last thing that I just want to say is like, I think crypto cap will do something like a Nasdaq, but it will, like the Nasdaq did in the past, basically. And so maybe we are here or we are here. It's hard to say really, but it looks very much like, if you look at this price action post.com bubble, right? Look here, VOP, it looks very much like VOP this here. I have to zoom in a bit. Right. So, 1, 2, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. I mean, yeah, this 800 EMA. So 800 EMA on the weekly. Let's turn on 800 EMA here as well. Where is the 800 EMA? We don't even have an 800 EMA on the weekly yet. We don't have it. We're not even 800 weeks. Look, in terms of the NASDAQ, we're still in this uncharted territory. We don't have an 800 EMA on the weekly. And so before there was an 800 EMA, we bounced off the 200 week EMA, and we are below the 200 week EMA. This is this one, the white one, right? So here it's kind of like here. So honestly speaking, in the grand scheme of things, a total 2 at 500 billion, not too bad. I do think what could be what if I would be a market maker and have to hedge basically my position and my risk, I would get rid of all the shit coins, right? All the memes and all the stuff that is not relevant for the future. It's not like any meme coin will like work with MIT to help the development of CBDCs or anything meaningful really. So that's my update, guys. I'm gonna enjoy my weekend now. If you need like some psychological advice of how to survive a drawdown, is remove all the crypto apps and things from your phone. Make sure that your coins are safe. They should be in a wallet. I'm not gonna say which wallet because I don't know. I'm not a dev. I cannot back anything. Like, please just do your research, Google, try to find reliable sources that can advise you on what's the safest way to store your crypto, right? So store your crypto safely, and if you really don't like this and you're losing money, get out of the market. Do as what you want. Do as you like, right? My point, what I do if I don't want to get angry or sad about these prices, is just like remove all my crypto apps. Don't look at the charts. Don't look at your portfolio. Don't look at your P&L. And like set a reminder for yourself in 1 year time. Also in 1 year time, we're gonna have a Bitcoin halving, so people might forget that as well. So short term, maybe some more problems. Long term, I still see mostly sun coming. I see that we're gonna have a summer soon, so I'm gonna enjoy that, and you guys should enjoy that as well. Keep your eyes on the price for the long term, and if you really don't want to be involved anymore, be my guest and sell your coins. But it's obviously what I said also many times: you want to sell in a bull market and buy in a bear market. It's as simple as that. So guys, have a good weekend. See you on the next one. Peace.